This is the Daily Market Comment by Mario Sajikiriakos. I'm Christina Marujos, and thank you for joining us at XM.com. The specter of rising interest rates has returned to haunt financial markets. The Fed breathed some life back into Treasury yields last week after it opened the door for a rate increase next year, and the rally has gone into overdrive this week, thanks to some signs that inflation won't cool anytime soon. There are essentially two energy crises playing out simultaneously in Europe and China. In Europe, it's driven mostly by a natural gas shortage that is feeding into surging electricity prices, while in China, a scarcity of coal has resulted in widespread power outages that have plagued heavy industry. When yields move higher, the assets that typically suffer the most damage are stocks with stretched valuations, the Japanese yen, and gold prices. That's exactly where the hammer has fallen this time. The tech-heavy Nasdaq is under heavy pressure as future cash flows are worth less when a higher discount rate is used in valuation models. Gold held up surprisingly well, but is unlikely to come out unscathed from an environment of rising real rates and a yield-powered dollar. With coal and natural gas markets going berserk, it's only natural that there would be a positive spillover effects into crude oil. And since changes in oil prices correlate quite closely with changes in market-based inflation expectations, the fate of this rally could ultimately impact monetary policy too. All eyes are now on OPEC. The cartel will meet next week, and the sword hanging over oil prices is whether it will react to the unfolding energy crisis by opening its supply taps even wider. If not, panic buying could kick into higher gear. The Canadian dollar hasn't capitalized much on rising oil prices as risk sentiment remains shaky and the US dollar has stood tall. That said, pairs like Loonie yen paint a much clearer picture of recent dynamics. The bounce in yields has re-energized the world's reserve currency, which is currently testing its recent highs against the euro. Since the ECB isn't expected to touch the interest rate button over the next few years, any rally in European yields tends to be limited, allowing US yields to rise faster and adding downward pressure to euro-dollar. Thank you for watching today's Daily Market Comment here at XM.com.